Ladies and gentlemen, please welcome back to the stage Ben Lapidus.
Lunch, how'd we do? Little hand thermometer? Yeah, all right, I'll take that one. Thank you. Oh, double up in the air above the head. Appreciate that. All right, so thanks for the positive feedback, the positive reinforcement. If you hear me out in the lobby, I'm not trying to interrupt your conversations. I'm trying to coolly let you know that we got rich content coming back to you in these shareable insights. So, who is here this morning? You guys do the rest of the morning? Okay. You guys enjoy the kind of capital raising side of things, hearing the ways sponsors lose money, hearing about different capital allocator strategies. We kind of had a bit of a capital raising morning, getting into the minds and the psychology of the LPs. Well, this afternoon is a little bit more about the operator side. So before we get into some of the beyond multifamily strategies, right, back to my values of promoting creative execution across all asset classes, before we get into that, something that I've been trying to get on this stage for a few years now is a mathematical, almost nerdy approach to modern portfolio theory. This is like MBA level content that as syndicators, as GPs, LPs in the real estate game at this mid-market level, we often don't think about. We compare returns against returns. We're looking at IRRs versus IRRs, yield chasers or cash flow chasers or whatever, but we're not doing apples to apples comparison with risk. Risk-adjusted returns is what matters. The amount of return relative to the risk in your portfolio. So, as our first speaker for this afternoon, I want to bring someone up who has specialized in risk management as a finance guy. On the executive team of Massive Capital, I'm excited to welcome Shahriar Khar to the stage to talk about modern portfolio theory.
Appreciate it. Thank you. Thank you so much. Wow. I know I got this slot right after the lunch, right? So kind of bear with me. So today, before I get started, I just wanted to share, I talked to the hotel staff. We don't have any planned fire drill for today. So if you hear any fire alarm, get out from the doors, go downstairs, and then we're going to wait for the next set of instruction. Now, that statement, what we call it a systemic risk. Just because we are here, just because the building exists, there is a chance there could be a fire. You haven't planned on it, I haven't planned on it, right? So with that lens, today I'll talk about risk. We get into real estate investments. In a sense, we are risk managers. So our goal is to take the least amount of risk and create the most amount of economic opportunity. Right? So let me see if I can go. Okay, great. So we'll talk about today the modern portfolio theory and how we can balance the risk and reward. I'll do a quick calculation. Then I'll show you a real-time case study. And if we have time, we'll take some questions as we go. I love Howard Marks. If you want to know market cycle, you should listen to him. He has his podcast. He has his memos. One of the great person to follow, especially to understand market cycle. We always say we cannot forecast market cycle. We cannot time market cycle. But we sure should understand where in the cycle we're at. And that's Howard Marks. Skillful risk control is the mark of a superior investor. All right, full disclaimer. I'm not an SEC attorney. I'm not a CPA, not here to raise money. All the conversation we're going to have is purely from educational purposes. Some of the numbers that I'll be using to show some calculation, those are fictitious numbers, just to kind of show the examples of how to look at risk and reward. Right? And hopefully when I'm finished after this 30 minutes, you guys should be able to say, hey, I understand very simple way what the risks are as I deploy my capital or as we acquire new assets. And hopefully, I'll give you 3 simple steps to review your portfolio. And 4 asset classes, those are the more opportunistic for 2025 and 2026. And this is one of my favorite quotes. We have bold investors and we have old investors. We don't have bold old investors. If you really want to test it, find somebody who hasn't invested in multifamily, put them side by side with someone who has invested for the last 3 years. You'll see the differences between bold and old and bold. All right, let's geek out on some of the finance. That's Jasmine Salinas. She leads our investor relations. She's supposed to be here. She's not going to be here today. On behalf of her, let's go have some fun with finance theories, and we'll create some economic opportunity as we go. Okay. So today what I will do, I will test some of those conventional understanding that we have, and we'll try to reframe how we take a look at return. The first is the return versus risk-adjusted return. That boils down to what we call it modern portfolio theory. And this portfolio theory was published in 1952 by an economist called Harry Markowitz. When he published his paper, his debate was, we understand the risk and reward, but if we do also understand the dependency of the assets within a portfolio, we can drive some of the risks out of the way. That means as a fund manager, as a capital allocator, when you deploy the capital, you should know that, okay, how can I take a little bit more less risk and create more economic value, right? So in other way, a very simplistic term, modern portfolio theory is a very practical, unbiased method to select investments to get the most return while you're taking the least amount of risk. I'll give an example. Let's say we have two projects, Project A and a Project B. Project A gives us 20% return. Project B gives us 20% return. Project A is a Class C, Project B is a Class A. And our bias will tell us, go take a Class A project for 20%, don't take a Class C. But if we look at purely from the distribution perspective, we should ask a question, hey, what is the standard deviation? Which is the KPI for volatility? Right? As a math person, when we look at average number or average return, it doesn't tell us anything. What it matters is the relative positioning of the average number. That means if I have a 20% return with the plus minus 20% deviation versus 20% return plus minus 10%, we should take the lower deviation project. And that's the KPI for volatility. And that's what we call it, hey, we don't look at risk versus reward, we look at volatility versus the return. So you're gonna bear with me for a second. This line, we call it a Fisher frontier line. What it's really saying that if you have a set of portfolios or set of assets, and for every optimal return, there's optimal risk amount. And once you plot it, you get a curve like that. In other words, every portfolio on that line, it's a very efficient portfolio for that point of risk that we're gonna go take. Another thing that I'll be talking about more is called risk-free return, which is a proxy is our 10-year treasury. So let's keep that in mind, and kind of bear with me for some of those terms. So risk-free return, it's a 10-year treasury, 4.5%, 4.6% today. When the risk-free return has a tangential line that touches the efficient and a frontier, that point, we call it the most optimal point. That means you are a nerd, you are a data geek, you're running all sorts of model, and you are going to say, I'm going to take the optimal risk to get the most return. That is the intersection of this line and that plot. It's a lot of work, so kind of bear with me for a second. So plots and all the portfolios on the curve are the efficient because they have the best return for the risk that we take. Now, this is a lot of financial theory, and I'll slowly walk you through using some example on the stock market, then I'll come back to the real estate, right? Let's take a look at it. Let's put a hat on. We are capital allocators. We are fund managers. We have a fund called equity fund, Fund E. And that is the risk and the return that we have, elected to take onto our portfolio for now. And then we have another fund. It's called Fund D, which is the debt fund. Right? Now the question is, we have an equity fund, we took some equity risk, and we deployed, bought a lot of multifamily, retail, or warehouse. Then we also have a debt fund we deployed as a lender, right? Now the question is, how can we calculate a happy medium fund? Debt, I took on a lot of risk, but I haven't get paid enough. On the equity, I took a lot of risk, but my return isn't big enough. So we're gonna push them in the middle, called a happy medium fund, right? Question is, how do we do it? Bear with me. The KPI of understanding the happy medium or the intersection, it's a term called Sharpe Ratio. It's a Sharpe Ratio, it does the expected rate of return, which is whatever return that you want to have on your portfolio, minus the risk-free return. Then we divide the standard deviation of the portfolio. And that's the beauty of it. What is the standard deviation of a portfolio? That one stock, how that variance with the other stock, right? I'm a runner. I run 4 or 5 miles, and a friend of mine, he does sprint. Now the question is, when we come together as a team, how are we gonna perform? Understanding that variance, we call it standard deviation. So let's get to work. Now, bear with me. All the math, Excel, and left brainers. So we have a portfolio. Let's say you have a portfolio. We're going to buy 4 stocks: S&P 500, gold, Microsoft, and bond index. And those are some given numbers that we have, and those are the risk deviations. And we elected, for whatever reason, that at a minimum, we'll buy 15%. At a maximum, we'll buy 35%. Now, the question that we're asking is, what is the best return I could expect taking the least amount of return? In other way, what's my highest Sharpe ratio? So what we do, you go to Yahoo Finance or Google Finance, you download all of those information for the last 2-3 years, and you run a calculation called covariance matrix. It's an Excel formula, so don't sweat over it. 10 minutes, you can get there. So what it does, it calculates the dependency of the stocks when you buy them in a portfolio. Once you have that covariance, we calculate the standard deviation. So all of a sudden, we know how our portfolio is going to behave if we have all 4 stocks force-fitted into one portfolio. Then we run a calculation. We say, hey, Excel, give me the maximum Sharpe ratio keeping my standard deviation in place. Simple math and a calculation. And if you really want, you can upload the Excel file, ask the ChatGPT, it'll calculate for you automatically. Life isn't that complicated, right? So, and this is what it shows. That if we were to get this portfolio, only 1/3 of the portfolio should be S&P 500, 1/3 should be bond, and 1/3 should be a mix of gold and Microsoft. What it really did, it looked at the standard deviation and looked at the return. It did the calculation and said, hey, Shahriar, if you are the fund manager, you should allocate 100% of your fund, and you expect about 6.3% return with a 10% standard deviation. The least amount of standard deviation for the portfolio. So as a fund manager, as a capital allocator, as a capital raiser, we should understand how much of a risk we are allocating to our portfolio versus the return. On the other side, as an acquisition operator, owner-operator, when we underwrite, we will also ask the question, what is my expected rate of return for an asset that I'm going to get into? So slowly, I will move a transition from finance theory to commercial real estate. So bear with me. All right, back to our beautiful chart. In this plot, what we have done 2 optimization. One optimization was we moved our equity portfolio, debt portfolio onto the curve, then we force feed it, right? So my question is, we all here for commercial real estate. We understand the concept. Now we have to make a forward-looking decision, right? All of the things that we have heard up until now, and we're going to spend most of our time tomorrow, it's backward-looking story. What has happened and what's going to happen for the next 12 months. But as an owner-operator, we have to make choices. Question is, how do you make choices? But there is a problem. Theory is great, but we don't have data. How do you go about doing so? We just don't. We don't understand the standard deviation of multifamily returns, how that co-vary with retail and the land. So we have to step back and ask the question, if I don't know, someone knows. Maybe someone who has 30,000, 40,000 units, owns thousands of acreage under the same portfolio, they can calculate, but we can't. But guess what? There's a hack. Let me show you the hack. So the hack is, let's make some assumptions, right? If the equation is there, we don't know how the equation is going to work, we can plug some numbers. And that's the hack. Based on our portfolio, based on our conversation, we believe a version of that is true. Not the absolute, but a version of that. What it means is that cash has the least amount of risk. No downside, risk per return rate probably, then debt fund, then a land all equity fund, then a pref fund, then an equity fund. That's your risk position as you kind of go through. Now, let's put a hat on it. We are LP investors. We are JV partners. We are family offices, capital allocators. We have to deploy the capital. What should we expect as a return? Right? We don't have any other data. So what we do, we look at the big shops. What is the market saying? And can I beat the market using market as a proxy? And this is your proxy. So if you are cash should not sitting out idle. You should put a CD, you should get 4 to 5%. Or if you get 4 to 5%, you're a great investor deploying your cash. If you are in a debt fund, 8 to 10%, that seems to be the range. That's where all the debts are available. So if a bank gives you 8% and you make 8% as well, you are in a good place. And 10% if you push the envelope a little bit more, take a little risky project. Land, all equity, not debt, all equity is 10 to 15% because it's a blend of debt and equity. Pref, 14 to 17, it's a standard. And LP equity, it's about 17 plus. So let me take a pause and talk a little bit about the number 5, why it's important. And number 4, right? Risk-free return goes up, pref goes up. If pref goes up, that has downside risk mitigated, and they're at a 15%, then if I'm an LP, I need to have a margin on top of that. What is the margin? You can decide between 3 to 5%. So in a deal, if a pref check is asking for 17%, by definition, an LP should get more than 20%. Now, if you flip the coin and you are an acquisition specialist trying to underwrite a deal, if your deal underwrites well at a 15 IRR for LPs, is it worth doing it? Because pref, once I bring in the pref, it kills the deal. That means the deal's not worth doing it. We see that time and time. As you underwrite, we're underwriting using 2022 assumptions, 2023 assumptions. We are not optimizing it. So that's where most of the deal falls apart, where we're seeing the deal penciled out at a 15 IRR for the LPs. Why would you take additional risk when pref guys are taking 15 IRR? And they sit behind the bank. As an LP, we sit behind the bank and pref and then, right? That gets really interesting. So now you have a benchmark. You have an expected rate of return, right? We know what to proxy after. So both from the LP side, both from the fund manager side, and both from an acquisition side, right? Let's look at it, how we can extrapolate that and do something for our portfolio. First thing first, map your portfolio. What we should do when you go home, pull up Excel file, as simple as that. Just have your investment hypothesis, write down all the projects you have invested or you plan to invest, asset type, geographical location, and map out the exit timeline. So you have an idea when your fund will exit. After that, you start adjusting. You do the same thing, but you put in what is the expected rate of return and how much capital that we deployed. Now, that's the kicker. As an investor, if your portfolio has higher risk than the return, you have invested the last 3, 4, 5 years, market did what market did, you have to adjust your portfolio and get it out of the way. And the only way you can get out by keep on investing. Now you have a reference point, expected rate of return. You have a reference point, what type of assets gives you what type of reward, and then you apply that in your investment hypothesis. And last but not the least, you ask, where do I go invest in? This is a report published by Deloitte. I love what they do. They seem to be pretty level-headed. 4 asset classes, we have the most amount of margin for next 2 years. Multifamily, business park, industrial, and single family. So if I'm an investor, let's go backwards. If we're an investor or owner-operator trying to acquire assets, we should focus on those 4. As we underwrite the deals, we should use pref, expected rate of return as a benchmark, then back into our risk profile, right? So from the finance perspective, risk and reward is very important, and this is how we can use proxy data to help us make decisions on a forward-looking, right? All right. So as we're talking about it, we gave you the 3 simple rules, simple way of taking a look at the risk. So let's give you a real-time case study on how we have acted on it. So this is us, Massive Capital. We started our Massive Capital 3 years ago. Since then, we acquired a little over $200 million of multifamily assets. So we are owner-operator of value-add multifamily. As the market turned, we took an equity position of a developer. It's a 42 years development company called Realty One. We have around $300 million worth of asset under management. Put together, we have $500 million worth of assets in 2 different asset classes, value-add multifamily and Class A retail center. Market turned again. We said we're going to adjust. So we added the land bank. So we do 3 things. We buy land. That gives us the downside protection. We do value-add multifamily. It's a moderate. And then we do more risk, which is the Class A triple net. And as we do that, we raise money from various sources. We have a couple of family offices we work with, high net worth, LP, LP and JV equity. Then on the construction side, we own the construction company. We have about 39 people on our payroll. All they do construction. Our specialty is the metal frame. That's why we do retail centers, metal frame, town centers, metal frame, and flex space. So we stay in our boundary, and we have a land development team. So we are playing with our strength, and we're optimizing our portfolio to a point when we have capital we have to deploy. We are not just looking into one asset classes. We have multiple options. Because as a money manager, our goal is to get the max for our money. And as we do that, we got to have multiple options. Without that, we'll be in a very tough spot. So our philosophy has been having one narrow strategy, buying a certain type of asset with a certain type of unit counts in a certain location for a certain vintage. Good luck getting one. On the other side, if you have a portfolio like that, if the market turns, the entire portfolio turns. To offset that, you don't have much of a time. So hence, we took a position as that, hey, we need a risk-adjusted portfolio, some less risk, have a little risk, and then have some additional risk as you go. Most of our assets in Texas market for all new constructions, and our multifamily is in Carolinas, Colorado, but mostly in Texas as we go. And who's Massive Capital? We have 3 partners. On the left, your right side, Shahriar. I do mostly corporate strategy and institutional funding. And then Mike in the middle, he's Mike Bailey. He's all thing money. He's our money guy. So he does our investor relations. He raised $45 million in the last 3 years or so. That's outside the family office. And we have Sanjay Agarwal. It's on your left. He looks at the acquisition and also the operation side of it. We all came from corporate finance and engineers. So us 3, all of us were retired engineers or recovering engineers. And then we went to the corporate side on the finance, M&A. And then we came into real estate about 7 years ago. And last 5 years, we transacted over 300 properties, about 30 retail, 20 or so apartments, and rest on the land side. So we have some internal database as you kind of go through. We like to hang out. We hang out every Tuesday, 6 p.m. CST. So we talk about finance, we talk about portfolio theory, we debate about where we are hurting, where we are winning, and how to position ourselves to get the most of the economic value we can create, taking the least amount of risk. The risk is a big deal for us. We always say that we are a finance company first, and then we happen to do real estate, because all day long we manage risk. If we can, and also on that note, we spend most of our money, most of our time not doing deals. Guess what? If we find the projects that I can save money by not doing it, what's on the other side? It's worth doing it. So 70-80% of our time that we spend, it's on the risk management, it's on why we should not do the deal, or why we should do the deal, and then we look at it, why we should do the deal, and when the deal comes, it's a very fast action. We can deploy the capital. We can take on an asset as you go. So on that note, thank you, everybody. I appreciate you guys allowing me to talk about some finance theory and then converting into a commercial and understanding the macro, understanding the micro, then positioning yourself as you do your investment. It's a very important thing. So hopefully you enjoyed it, and thank you very much.